Hello, folks. Steve Lentz here with Discover Options here at Option View Systems International. Welcome to this presentation of 3 different market timing reports for advanced options traders. These will be for Friday, December 22nd, getting ready for the open on Tuesday, the 26th. Presented material today is for educational purposes only and should not be construed as personalized financial advice. Past results are not necessarily indicative of future performance. Before we get started, please consider subscribing. That way you get alerted whenever we come out with new videos. Also, we have a free ebook for those of you that do not have this, Simple Steps to Options Trading Success, co-authored by myself and Jim Graham. Just click the link, give us your information, we'll get that right out to you. We have 3 reports for you. The Condor Butterfly Timing Report in the S&P 500 is for those that trade market neutral premium selling strategies. Answering the question, is now a good time to implement a Condor or Butterfly campaign? The Bull Put Spread Timing Report presupposes that you're selling puts, a standard deviation out of the money about 30 days out. And answering the question, is now a good time to implement that strategy in the S&P? Finally, the statistically minded will benefit from the Directional Likelihood Report, answering the question based upon past occurrences of the current market condition. Where's the market likely to go? So let's get going. Here is the market condition that we will address for all 3 reports. As we call this the current market condition, and we like to look at market condition from 3 different dimensions: price action, the trend, and then the stochastic situation. The price action, we had an upswing day on Thursday and then a downswing bar on Friday. That is a fairly common price action. That took place, though, when the market is trending upward well above its 50-day simple moving average. And in terms of the stochastic situation, we're kind of in the overbought level, trending downward beneath the 3-period simple moving average, or what is called the %D, for those of you that are stochastics aficionados. All 3 dimensions make for a market condition that's occurred roughly 156 times from January 2000 to the present. That's a pretty good population of occurrences for us to look at and extract some conclusions about. So let's get going with the first report, which is the Condor Butterfly Timing Report. Since January 2000, we've had roughly 4,543 daily closes of the S&P 500. Now, of those, over 4,500, 65.5%, almost 2/3, have been favorable bars for selling option premium, where the actual 21-bar movement, turned out to be less than what was being implied by the option prices, or what we call the SIBO skew adjusted VIX. And so that's in that environment, you want to do condors and butterflies, market neutral approaches with it benefit from a market that's not as active as what the option prices are implying. So 2/3 of the time, the S&P has had those favorable bars. Now, also since January of 2000, our current market condition that I just went over has occurred 156 times. Now, of those 156, 75%, 3/4, have been similarly favorable for premium selling. Now, that's more than the benchmark historical baseline of 2/3. 3/4 is more than 2/3. So we have an edge. This implies an option premium selling edge of 9.5%. So statistically, looking at the past occurrences of the market condition we have today, it's more likely than usual that our market condition will end up being a favorable one for market neutral option premium selling. So that's it for the Condor report. Let's go to the Bull Put Spread. This presupposes, as I mentioned, selling put options, a standard deviation out, 30 days in the future, with a days to expiration roughly 30 days out. And ideally, the market will not move down and hit that short strike when you sell those puts through a bull put spread. So here's the report as we have it today. So it's just January of 2000, as I mentioned. We've had over 4,500 closes of the S&P 500. Now, of those 4,500 plus, 83.3% have been favorable bars for selling put premium, like I mentioned, where the actual 21 bar movement to the downside was less than what the option prices were implying. We use the skew adjusted VIX to determine that downside expectation. Okay, so you could flip a coin, and 83% of the time you're going to catch a bar where the market does not move down and hit that short strike, a standard deviation out 30 days in the future. Okay, so but also during that time, our current market condition, as I mentioned, has occurred 156 times. Now, of those 156, 86.5% of the bars were similarly favorable, where the market did not move down as much as what was being implied. So that implies a put option selling edge of 3.2%. So statistically, it's more likely than usual that Friday's market condition will end up being a favorable one for selling out of the money put premium. Okay, so with that, let's go to the final report, and this is the market likelihood report. And what we're doing is just looking at the past our current market condition as it occurred in the past, and asking ourselves, based upon what happened then, in this case, this particular scan found 160 occurrences. Based upon those 160 times when the market duplicated this current condition, what did the market do then? And can we extract what the likelihood is that it's going to do now? Did it go up, down, or wobble around a bit? Well, to answer that question, we use what we call price distribution bands. And so what we do is we take the close and we go a standard deviation to the upside and the downside. In this case, you're looking at the 5-day distribution bands. And the question is, will the market go up and hit the upper band, the lower band, or will it wobble around and not hit either of the band? Just looking at the right-hand bar there. Okay, and so after 5 days goes by, we take note of that and log it in a database. And we do this not only for the 5-day bands, but the 10-day bands and the 15-day bands. Now you might notice that the upper bands are a little bit closer to the close than the downside bands. And that's because of the vertical skew that occurs in the S&P 500 options. The out-of-the-money call options have a lower implied volatility than the out-of-the-money put options, and that's why you see this asymmetrical look there to the distribution bands. So that's what we use in this particular case. Now, let's come back to the report. Look at the top line. Historical distribution, 4,543 occurrences. The upper bands were hit. The 5-day band was hit 21.6, 10-day band 16%, upper 15.1. The lower 5-day band was hit 16.4, 16.6, and 19.3. All right. Now, and so this is the historical baseline as to how often those bands were hit. Now, of the 160 occurrences of our current market condition, of those 160, the upper 5-day band was hit 13.1% of the time, which is 8.5% less often. You see that? And in fact, not only was the upper 5-day band struck less often of those 160, the 10-day band and the 15-day band, those were similarly struck less often. The lower bands were struck less often as well. All 6 bands were struck less often. And this is a picture of lower market volatility in general. Lower market volatility. Now, and by the way, if you want to, well, let's go to the other one. What I do then also is just to give you guys a little bit of a better look here when in this case, Tuesday's open comes around. When Tuesday's open comes around, If the market goes above Friday's high, okay, what's the distribution in that particular case? Well, of these 160, 61 times the market went above that previous bar's high. Of those 61 occurrences, okay, the distribution was similarly such that the market hit all 6 of the bands less often. When the market went down below the previous bar's low, the distribution was similar. That was 91 times. The market was similarly less volatile in all 6 bands, getting struck less often. Now, is there any kind of directional bias to this distribution? Okay, well, if you look carefully, you'll see that the upper bands were struck less often than the lower bands. Okay, and you want to kind of look at that with a filtered eye a little bit. Certainly the 5-day bands were struck quite a bit less often, but so you can judge some directional bias. I think you would probably lean a little bit bearish if you were to make a conclusion, but all the bands are getting struck so seldom that it's tough to really extrapolate any kind of an edge in that regard. Altogether, we have a situation where it's likely that the market will be less volatile than what the option prices are implying. It doesn't mean the market is guaranteed to be less volatile, because you can see here those bands do get struck roughly on average 1 time in 10, altogether. But we do have a definite likelihood that the market will be less volatile. Okay, so that's it for that report. Folks, thanks so much. Hope you have a great holiday season here. And we'll see you again next week, the same time on the same channel here. Take care. Have a good, safe holiday.